Okay, you guys, now that we know that bonds can be issued at a discount or a premium, meaning, at an issue price above or below the face amount, we need to know how to account for that. We've already looked at how to make the journal entries when bonds are issued with the same stated rate and effective rate. So let's look at how we handle the discounts and premiums. All right, now this one's going to look familiar to you, assuming you're watching the videos in order. We've got Mac Company issues $750,000, 8% 5-year bonds on June 30th, 2024. The bonds pay interest semi-annually on June 30th and December 31. And at the time of issuance, the effective rate of the bonds was 10%. Now, you saw that in the last video worked out, and we used that information to calculate the issue price. And we have all that info here. Remember, the $692,085 was the issue price we calculated in that previous video. So now how do we record that? Well, they go into here, since the issue price is less than the face amount of the bond is issued at a discount. We've talked about that. The discount must be amortized over the life of the bond. Now, this is new for us. In other words, we must allocate the discount across all of the interest payments. So it's amortized over each interest payment period. And a discount will cause the interest expense to be greater than cash paid for interest in every interest payment period. And to me, I always think of, you can read the rest of it there, but I always think of it as if we receive less than the face amount up front for the bonds, then that's going to increase our interest expense in all of our future periods associated with the bonds. If we issue the bonds at a premium, meaning we receive more than the face amount for the bonds up front, then that will decrease future periods' interest expense. That's how I remember it. You can read through this as well. It just says because we pay interest at the stated rate of 8%, but the bonds are sold to yield a return of the effective rate of 10%. So the amount of interest expense we will recognize each period will be greater than the cash payment. That's with a discount. To me, it makes sense that if we don't receive the full face amount up front, meaning that we have a discount, then our future period's interest expense will be larger than cash paid. But if we receive more than the face amount up front, then that will, when we amortize that premium, that will decrease future periods' interest expense. To me, that's the easiest way to remember it, but whatever works best for you. But I think it'll make more sense as we go through the calculations too. But before we can record the entries related to the bond, we must first do an amortization schedule. Well, you guys, this amortization schedule just lays out all the numbers we'll need in the journal entries to record the issuance of the bonds at a discount. Now, in amortizing that discount or premium, there's two ways two methods of doing that: the effective interest method and the straight line method. Now, you've seen the name straight line before with depreciation, and just like with depreciation under the straight line method, it means we would take the same amount of amortization each interest payment period. But that's not the preferred method under GAAP. The preferred method under GAAP is the effective interest method. And with it, our interest payment is always the face value times half the stated rate. And that's static, right? That's the same for each interest payment period. But our interest expense is always equal to the carrying amount of the bonds times half the effective rate. And then the carrying amount or carrying value of the bonds payable is equal to the face value plus any unamortized premium and minus any unamortized discount. So we'll fill in this amortization schedule here, you guys. The carrying value of the bonds when they're issued would be equal to the issue price. All right, then to get the interest payment amount on 12/31/24, we'll take the face value of the bonds, $750,000, and multiply by half the stated rate, so times 0.04, and that gives us $30,000, and that's the amount of the interest payment that we'll make at the end of 2024. And you guys, that one doesn't change, right? Because the face value remains the same and half the stated rate remains the same throughout the bond term. So that $30,000 is the amount of cash that will be paid for interest in each of these interest payment periods. Now the interest expense recorded each period is going to vary because the carrying value of the bond is going to change as the discount, in this case, or premium, as we'll look at later, is amortized. Okay, our interest expense is the carrying amount times half the effective rate. So that's going to be $692.85 times half the market rate. The market rate was 10%, so half of that would be 5. $34,604. We'll round to the dollar. And then discount amortized will be the difference in these two amounts. So $46.04. All right, and then that amortization of the discount will be added to the carrying value. So we got $46.04 plus $692.85, and that gives us $696,689. Is our new carrying value. I always want to say carrying amount, and now we'll just keep going with this process. Now again, cash paid for interest will remain the same. To get the next, to get interest expense for 6/30/25, we'll say $696.89 times 0.05, and that gives us $34,834. As interest expense. The amortization of the discount would be the difference in interest expense and cash paid for interest. So $4,834. And then that amortization of the discount would be added back to the carrying value. So we've got $48.34 plus $696,689. And that's $701,523. That's our new carrying value at 6/30/25. Okay, then we'll multiply that times half the market or effective rate again. I shouldn't have cleared that, but 701,523 times 5%, 35,076. Is interest expense. So that's 5,076 for the amortization of the discount. Now that'll be added to the 701,523 to get your new carrying amount. So 5,076 plus 701,523 gives us a new carrying value of 706,599. And then we'll multiply that amount again times half the market rate, 5%, gives us interest expense for 6/30/26 of $35,330. Rounded, of course. Oh, wrong spot. $35,330. Rounded. Okay, so the amortization of the discount again is the difference in cash paid for interest and interest expense. So that's $5,330. We'll add that to the previous carrying value to get the carrying value on 6/30/26. 706,599 plus 5,330. 711,929 is our carrying value then at the end of June 2026. All right, now I know that's kind of cumbersome. It took quite a bit of time, and really, you guys, these are the only formulas you need to run that schedule. The nice part about that, though, I knew you were hoping there was a but coming somewhere. It is cumbersome, but once you get that chart completed, it just kind of lays the amounts for your journal entries out right in front of you there. So, we're ready to record the bond, the first interest payment on December 31, 2024, and the second interest payment on June 30th, 2025. Okay, so I'm going to bring this schedule down with, it didn't work that way. Okay, we'll refer back up to this schedule as we're making the journal entries. But first, we'll make the entry to record the issuance of the bonds on 6/30/24. Okay. So with our first entry here to record the issuance of the bonds on 6/30/24, the issuing corporation is going to have more cash, right? So we'll debit cash for $692,085, the issue price. All right, and we know we're going to credit bonds payable for the full face amount, $750,000. So that means we need to debit something else, right? Well, that's where the discount goes on the books. Discount on bonds payable is debited for $57,015. Just the difference in our issue price from here and calculated on the previous video. It's the difference in it and the face value. Bonds payable always goes on the books at face, and it'll later come off the books at face at the end of the term. And cash would go on the books when the bonds are issued at the issue price. If you need more debit to balance the entry, there's a discount. If you need more credit to balance the entry, you have a premium. But anyway, that's cash coming in from a financing activity, right? And the asset cash increased $692,085, and liabilities increased by $750, but then decreased by the discount. So in total, liabilities increased $692,085. All right, now to do the first interest payment, it really helps to be able to see this chart here. It'll be 12/31/24. We're going to debit interest expense for the amount in that column. We're going to credit the discount on bonds payable for the 4604, and we'll credit cash for the amount of the payment, $30,000. I don't think we're going to be able to see it though in the journal entry at the same time, but we'll debit interest expense for $34,604 here. We'll credit the discount for the amount of its amortization, $4604 here. And then, of course, we'll credit cash for the amount of the payment each time, $30,000. Or what happened here? Cash went out for operating activities. The interest on the note you got, or the interest on the bonds, is always considered an operating activity. Same for interest on notes as well. We looked at that in an earlier chapter. But here we've got an expense, interest expense that increased by $34,604, causing net income to decrease by $34,604. Also causes stockholders' equity to decrease by $34,604. And then what? Cash decreased by $30,000, the credit to cash, and liabilities increase when the discount is amortized, you guys. That'll cause bonds payable balance, which is shown at its carrying amount, to decrease. All right, our next entry looks exactly the same as this one, except we get our numbers from the next row, 630.25 from our amortization schedule. We're going to debit interest expense for $34,834. We're going to credit cash for $30,000 and credit the discount on bonds payable for the difference. And again, that's just your 630.25 row from the amortization schedule. So I know this takes some time, but it does make the journal entries very easy. All right, next. I guess next we go to the next video. I thought we had another page coming up there. You guys, I hope that makes sense. Give it a little time. I think it will. Just practice through it. And as always, please be in touch if you have questions. Thank you.